watch me on time so I don't get into lunch here.
It's 11:01, so
yeah.
look at me.
Okay, so this should be less stressful this morning because this is really just a review of information just before you get started doing your AFRs next year. So in 2019, we covered a lot of changes that were going into the AFR for 2020, and we alluded to changes for 2021. And we're going to talk about those and try to clear those up because I think there's confusion because of the delay in implementation of some of those changes. So the AFR is the basis for the regulatory financial statements. The changes that we are doing are called the Enhanced Regulatory Report. Okay. And we also covered how the financial statements would change for 2019 and 2020. When the pandemic hit, it changed everything, including this. We were trying to learn how to audit remotely. We had limited access to the units that we were auditing. We had to rely heavily on electronic files and transmissions that Ricky was going over. It was determined that with all of that additional stress, it was not the best time to implement changes to the financial statements and audits of those statements. So we delayed the implementation. Okay, we're going to go over what the delay meant as far as your 2019 and going forward into the 2020 AFR that you will be completing. So as a reminder, we issued this memo on April 27th, and Ricky's already alluded to on our homepage. You can find all of these memos on the delays to the audit of enhanced regulatory basis. Again, this is mainly due to the logistics of remote auditing for every unit, and this was we were focusing on how to continue ongoing operations and continue to provide services at the same time, protect our employees, your employees, the public. So delaying the changes meant we weren't asking for additional financial records to support those changes, and that really was a great benefit of delaying it. On this slide, I provided a link to this memo and also want to remind you that, again, all the directives, memos and guidance are on the homepage, and we will be adding the one that Ricky was alluding to, talked about
It's
earlier.
up there.
It's up there now.
It's up there.
It's there. So you can get it. Okay, so we already discussed the changes in the AFR for 2019. We're to move the regulatory basis to the Enhanced Regulatory Report, which added more information to the traditional report that we had been giving. We had planned to audit those changes and issue our 2019 audit reports on the Enhanced Regulatory basis. However, delay meant that the audit of the 2019 calendar year did not include those changes that we had talked about in 2019. Your audit reports for 2019 were completed on the regulatory basis that you're familiar with and not the enhanced. This delay streamlined the audit process for this year, reduced the amount of time and records needed for audit. However, we had already made the modifications to the annual financial report in the gateway system prior to the pandemic, and you had already completed those changes when you completed the AFR for 2019. Those changes that were in effect for 2019 continue to be in the AFR report for 2020. However, we did not make any additional changes. So the changes that we had hinted at for the 2020 AFR are not been put in Gateway. So the Gateway you're doing, or the AFR you're doing in 2021 by March 1st is going to be similar, it's going to be the same as what you did for 2019. One of the biggest changes that we had been talking about and training on for 2020 was the addition of a schedule of accumulated depreciation. That schedule will not be required for your 2020 AFR. So you will not have to have that information. We're going to come back to that. Okay. For those counties that were required to produce financial statements on the GAAP basis, the delays outlined in the April 27th memo did not impact your requirements for your financial statements. The State Board of Accounts defines the regulatory basis of reporting, and state statute authorizes the state examiner to prescribe the form for the financial report. For that reason, the state examiner could and did make the decision to delay the rollout of the enhanced regulatory changes. However, GAAP, which stands for Generally Accepted Accounting Principles, is established by accounting standards boards. For governments, that entity is the Governmental Accounting Standard Board, or you might hear it called GASB. They currently have a 90 statements, and they have 4 more that are currently under consideration, although they did delay implementation of some of those for the same reasons. But GAAP is uniform throughout the United States. So GAAP is not something we can control in the same way we could with the regulatory requirements. And since Indiana statute required the counties with populations over 100,000 that wish to issue debt to compile their financial statements based on GAAP, that continued to be a requirement this year. Okay. And as a reminder, the whole purpose of the enhanced regulatory report is to add some GAAP elements to the enhanced regulatory report to provide more meaningful information to the users of the financial statements. This includes your legislators, your bonding agencies, financial institutions. It is in hope that the enhanced regulatory report, in addition of those GAAP elements, will prevent the need for all units to report on GAAP. So this slide is just a reminder. This was how your 2018 and before, and also your 2019 financial statement was shown in the audit report, because we delayed the issue of the enhanced regulatory. And again, this is what you've been familiar with. The funds run on the left-hand side along the top. It has columns for cash and investments beginning of the year, your receipts, your disbursements, and your cash and investments at the end of the year. And at the end of the statement, we show a total of your beginning balance, receipts, and ending balances for all of the funds combined. This does not differentiate between types of funds, so even funds that are for accounting or remittance or trust are included in the total. For readers of the financial statements, especially if they don't have the expertise to understand the purposes of individual funds, this schedule shows a total cash balance. However, that balance does not represent the operating funds of the county. Many users focus on that total balance and believe the county has the entire balance available to spend as if the entire balance were general fund. So therefore, it does sometimes mislead the less sophisticated readers or citizens. Often we get complaints about that, and that's one of the things we wanted to change, which was delayed a little bit. If we were able to audit the changes for 2020, this is what the financial statement will start looking like. So it adds additional information. This is some of the same information that was in the supplemental report, but in this case, it's going to be moved forward and be part of the actual financial statement, and it will have an opinion on it. We will have our audit opinion on this financial statement. In this format, the funds now run along the top of the statement, and under each column, you will find the beginning balance, the receipts in much more detail, disbursements in more detail, a line that shows if there is an excess or deficiency of receipts over disbursements, and the cash and investment balance for that fund. This does help the reader focus on the individual funds, although they are still not categorized by the type of fund. It also provides the reader more information on where the revenues come from for each of the funds. It shows how the fund is spent by expense classification, and that excess deficiency line shows if revenues are sufficient to support the cost of the fund, or if the reserves are being used to meet the budget. As I said, prior to 2019, this was part of the supplemental schedules. It will now be included as part of the audit report itself, or the financial statements up front. And what that means when we come into audit for 2020 is that we have to audit the individual classifications of receipts and disbursements that they're shown on this report, which is not something we had done prior to the implementation of this, and is not something we did in 2019, for 2019. So we went over this in May. This is a slide from that, and that presentation is still available on our website if you want to go back over it, but this is just a reminder. Using Gateway and putting the annual financial report on the Gateway allows for comparability between the different units' financial statements, and this information then is available to the public. We'll hopefully cut down on public requests for financial information directly from your office, because they can go to the website and get this. However, if the data is not comparable, this process doesn't work very well. So the chart of accounts was developed for counties to provide that standardization for county funds. Some common funds may have different names within your county software, But as these funds are the same, despite the different numbers, using the standard numbering format provides that comparability. And we gave an example. You can have county, highway, MVH, motor vehicle highway, they're all the same fund. Your county might use a different name, but if you keep using that standard fund number, you're able to compare them across counties and cities and towns as well. The custom funds are the local funds and grant funds that are specific to your county, usually established by a local ordinance or by a federal, state, or local grant. Do not make a custom fund when you have an established fund already. It confuses everything. It makes it a lot more difficult to audit. So if there is a statutory fund and it's in the chart of accounts, please use that fund. And again, a reminder for the local income tax, when we changed in 2017, we transitioned away from local option income taxes, what your CAGIT, CODIT, CEDIT, public safety, LOIT. We moved to local income tax or LIT funds. We left them in so we could do the transition, but when you do your AFR for 2020, that you're going to be doing in January and February, these funds, the old funds, CAGIT, COIT, LOIT, will no longer be available. So make sure you've made the changes so that you can map and get them in the correct fund name, fund number and name. This also affects your settlement funds because we did remove CAGIT, COIT, and CEDIT, and you should just have one fund lit for property tax relief. And also your remittance funds, we took those out as well, where you're moving them in and then distributing to the county for the local income tax funds. There is a mention here, there should only be one E911 fund, so make sure you're using the proper fund. There should be only one reassessment fund, so make sure you're using the proper fund and the others are closed out to that. And as we mentioned in May, if you have this is not a big deal because there are not that many counties, but if you have the Child Advocacy Fund, that should be eliminated. Close it out to your general fund.
Emergency telephone and statewide 911 should be reported together?
There is only one E911 fund. So yes, the money that you get from the state based on both landlines, if they exist, and cell phones, that money is running through the state and is distributed out to the counties to operate their PSAPs. There should just be one fund that accounts for all of that money. And you have to we do an audit of those funds as a separate audit for the E911 board, but there should only be one fund. Again, this is just a reminder of the types of receipt and disbursement categories you will be using. So the Enhanced Regulatory Report financial statement will display the detail of receipts and the detail of disbursements for each fund. In the future, we will be auditing. So in 2020, when we're auditing, or 2021, when we're auditing 2020 financial statements, we are going to be placing an opinion on whether or not those are materially correct as presented, which includes that classification of receipts and disbursements. If you choose other receipts or for all of your receipts or other disbursements for all of your disbursements and all of the funds, that is not going to be materially correct. I know that's an extreme case and you're not doing that, but even in some of your other funds, that may be an easy default, but make sure if it fits one of the categories other than other, that you are using the appropriate category for both receipt and disbursement.
I got two more.
Okay.
If we have money in Fund 1115, it goes to County General. Do we need anyone to approve this transfer? That's my one question.
1115 was the Child Advocacy Fund. Unless you've put money into it recently, because 100% of that fee should be going to the state. So if it's just a dormant fund that's been sitting there for the last 6 or 7 years, you were to use it at the time to finish those projects, and then there was no requirement to turn that money in. So no, you could just move that to general fund as long as you haven't been adding to it. If you've been putting money into it, that needs to go to the state.
And so emergency telephone should be Fund 1153. That revenue stream is a levy?
It's not a levy. It's a distribution of the E911 fees that everyone pays for their phones. It's not a tax levy.
Okay.
Sorry. So your major classifications of both receipts and disbursements should be determined at the time that the receipt or disbursement is posted. This should follow your revenue lines that you've already established or your appropriation lines based on your budget. This will allow the upload to post the receipts and disbursements to the correct classification. Even if you were manually entering your funds, having them classified properly at the time you're posting is going to save you so much time to make sure that they get reported in the AFR properly. Okay, and again in May, we went over the classifications in more detail. That presentation is still available on the website under Presentations and Training on the Auditor's page. The Uniform Chart of Accounts instruction is also available on that website, again on the Auditor's webpage under Overview and Chart of Accounts. We have received questions on classifying receipts and disbursements throughout this year. For the most part, you already know what you're doing. You're doing it right. You're just getting confirmation from us. So trust in yourselves and your staff. You guys know what these are and just make sure you're using them. Okay, the notes of the financial statements, remember, are considered part of the financial statements. These notes are audited. We do include the notes in our audit opinion on the financial statements. So in addition to the changes in the format and information on the financial statements, there were changes to the note disclosures for debt, leases, interfund transfers, and pensions. The ones that you filled out for the 2019 AFR are going to be the ones you're going to fill out for 2020. There were no new additions to that. So the debt schedule, again, was in a supplemental schedule, but it will be part of the notes, the financial statements, so it will have an opinion on it under the enhanced regulatory. None of that, again, none of what has changed from what you put in for 2019. We didn't make any changes to it, so it's more going to be just updating it for the current year's information. We are still going to pull from amortization schedules that we have, so really you're just going to want to make sure that it's showing the most current information and that the information ties to your schedules. The note has two sections: the changes in long-term debt, which shows the beginning balance, the additions or reductions and ending balance for each debt classification. It will also show the principal and interest due within 1 year, so that's the part that's probably going to change. The second section of the note, which is titled Debt Service Requirement to Maturity, shows the principal and interest due in increments until maturity, and then it is in 5-year increments after that. So this is what the first schedule is going to look like. It's just a sample of the information that's going to be available. Again, this is going to be a note in the financial statements. And the second part of it will look like this. And again, it will be right under that first section in the notes to the financial statements. Leases also is a separate note. Again, the information that you entered in 2019 is the same type of information that you're going to be entering for 2020, just updating it or adding new leases. Okay. We can pull this information from amortization schedules if those are already been loaded in Gateway, even through DLGF's app. We can access that and pull that information forward. You need to make sure that if you have entered information into the debt management report for DLGF, that information is accurate, because that's what it's going to pull forward. The schedule for transfers will be included in the notes to the financial statement. We did receive quite a few calls on completing this transfer schedule when you were doing your 2019 AFRs. As a reminder, Gateway does generate a report called Transfers that you can find on the Annual Reports Outputs page in your Gateway. This report shows all of the funds for which you show a transfer in or receipts on receipts or a transfer out of the disbursement. So it's a good place to start. So when you've uploaded the information, this is isolating the ones that you had transfer in or transfer out as of a classification of receipt or disbursement. The problem is it will show it in aggregate. So if you had 5 transfers out of your, or 5 transfers into rainy day from 5 different funds, it's going to put 1 rainy day total. And for the transfer schedule, you need to have those disaggregated. So the money that came from general fund to rainy day is on a line. The money that came from public safety lit is on a different line, showing each of those individuals. So that's the only thing you'd have to do. But that schedule is a good place to start. When you call and ask us questions, I will often pull that out and start with it. And even over the phone, we've been able to work through it and figure out what should be on the transfer schedule. So even without having access to your other financial information. So it is a very good schedule. I think it's a very good tool.
You're good. You have 10 minutes. 9 minutes, whatever.
We did an exercise when we did the quadrant meetings. When was that? Last fall? No,
Last fall.
Yeah, last fall. Okay, when we did those quadrant meetings last fall. We did an exercise on the transfers to try to show how you can put that together. That is still available on the website. So it's something you can go back and look at with concrete examples of it. And again, don't ever hesitate to ask us. Don't spend a lot of time. If it doesn't make sense to you or it's not coming clear, just call and we'll brainstorm with you and try to figure a way to move ahead so it doesn't get you bogged down on this, on any of the notes or any of the new information. Be sure and let us know if you have a problem. So this is what the note for the transfers will look like. The fund that the transfer was taken out of, it's going to be in that first column. So in this example, we transferred from the general fund $300,000 into motor vehicle highway, and $7,500 into supplemental beverage and beverage. I'm not sure why we did that. We did. Anyway, I'm not sure why we did that. I think it's just to show an example of what the transfer would look like. Those aren't really legitimate transfers. Sorry, looked at that for now. But anyway, on the right side, you're going to have what fund is coming out of, and on the left side, you're going to have what fund is going into individually. So you're not going to have it in the aggregate, so you can see where the money came, which one it came out of, which came back in. And it's possible to have it go from general fund to rainy day and then maybe come back from rainy day to general fund later in the year for some reason. So both of those transfers would be on there to show where that flow of money is. Okay, you should probably be well aware now the pension note was significantly expanded under the enhanced regulatory, but it is the OPEB information that seems to cause the greatest amount of difficulty. For counties, you've got your IMPERS reports to handle your civil, and then you've got your sheriff's pension, and you usually get a report from your management, your trustee,
Yes,
to give you the information you need to load in on pensions. But OPEB has caused a lot of problems. So OPEB stands for Other Post-Employment Benefits. These are the benefits paid to a former employee after the employment ends, if the employee meets the requirements for those benefits. So the requirements might be something like the employee has reached a certain age and has a designated number of years of service with the county, like they're over 55 and they've worked at least 20 years. This is similar to requirements to receive a pension. It's just benefits other than a pension. Okay. We did want to note that we had a lot of confusion between OPEB and COBRA. COBRA benefits are not OPEB and do not need to be reported. COBRA stands for Consolidated Omnibus Budget Reconciliation Act, in case you ever need to know that. What it does is provide eligible employees and dependents the option of continued health insurance coverage when an employee loses their job or experiences a reduction in work hours that make them ineligible for health coverage through their employer. The employee losing the coverage has 60 days to claim the coverage, and it covers them up to 18 months. This is not OPEB, so do not include any of your, even if you have to combine your receipts for some reason between your OPEB benefits and your COBRA. Make sure you've separated the COBRA out. The requirements for the OPEB plans are basically the name of the plan, whether the plan is a defined benefit or defined contribution. Defined benefit means that a specified benefit is provided and doesn't depend on how much is paid into the plan. The defined contribution plan means that a specified amount is paid into the plan, and that is what is available at retirement, whatever has been paid into it. If you have health insurance coverage, that would be a defined benefit, and if you as the employee have a set amount in an account to pay for health insurance, that's a defined contribution. So if you have a Viva or something like that. The coverage would be the type of benefits provided. So what are you getting out of this health benefits insurance? What is the plan covering? Okay. Participants are either inactive employees or beneficiaries that are currently receiving the benefits. Okay. No, they're active. Okay. Participants are active employees or beneficiaries that are currently receiving the benefits. Inactive members, they're no longer on the payroll, and they're not currently receiving benefits. That's an inactive. Okay. Active employees are employees that will be eligible and they're still on the payroll. So that's the difference. They're inactive, meaning they're no longer paying into the payroll, but they're still eligible for that benefit at some point in time. Sorry, I confused that. Contribution rate seems to cause the most problems. This is the amount that the employer, that the county is paying for this benefit. Okay. For example, the county may pay 12% of the salary and the employee pays 6%. Okay. That's a contribution rate to fund this benefit. Okay. And this is for plans that are pre-funded. If you provide these benefits on a pay-as-you-go, which means you haven't pre-funded any of this, you just pay the premium as it comes due for your retired employees that are eligible for it, then you are showing 0 for your contribution rates. You're not pre-funding it. So don't overthink this. If it's a pay-as-you-go, then there is no pre-funded amount, no contribution rate. Okay? The contribution rate is only if you have a set amount you're paying into a trust to pay for this benefit. And again, call us if you have questions. We're glad to go over it again. The supplemental schedules, we were assuming the capital asset schedules would have been moved to the notes. That did not happen for the 2019 financial statements. You still had to put that information in, and that information on your capital asset schedule is still required. Okay. They should move, as long as the delay does not continue, they should move then to a note to the financial statement for your 2020 financial statements. So in completing the 2019 capital asset schedule, you were required to supply additional information on additions and deductions or deletions from your capital assets and a beginning balance. Prior to this, all you ever had to show was the ending balance. Now the schedule shows the beginning balance, which should tie to the ending balance of your prior report, any additions to any of the categories, any deletions or retirements of capital assets, and then an ending balance by category. You will not need to complete accumulated depreciation when you do your 2020 AFRs. It is not going to be a schedule that's in there. This has not been programmed into Gateway. So yes, you get a little bit more time to work on that, and we will be working on additional training on that. Maybe even, as Ricky was saying, some short, 1 hour or less sessions, maybe some hands-on, maybe sending you out some work papers to work through and then going over them together so that we can kind of get you used to how you make those calculations, but you do not have to do this for the 2020 AFR. So again, this is what the information in the note will be for 2020. Instead of a supplemental, it will move now to a note to the financial statement. No, it will stay supplemental. I'm confusing myself. Yes. It will stay supplemental. There will not be an opinion on your capital asset schedule for 2020 either. Okay, it's going to be 2021 before we will have to put an opinion on that. So it stays in the supplemental schedule. It just has more information. Again, so it's showing it's going to have the beginning balance, the additions, reductions, and the ending balance, again, by category: land, infrastructure, buildings, improvements, etc. So you do need to have this information, and you do need to load it in. They are looking at your capitalization, so make sure you have your capitalization policy, your capital assets ledger, your supporting documentation. Keep any basis for asset valuation. And again, go back and look at some of our previous training on this, and we will be hitting it again if any of these terms don't seem familiar to you. But again, how you value those assets, how you determine what the historical cost was, how long you think the estimated useful life is for particular assets, and also your internal controls over tracking and accounting for your capital assets. I'm out of time. So really quickly, the last few slides, and I'm not going to go over them in detail, are the supplemental AFRs. You still have to get those from your units, from your departments that have financial information outside of your funds ledger. So here's just a list of common ones that you need to have. Also make sure you do, even though it's limited, you need to make sure that these schedules seem reasonable. Some kind of thing that they aren't completely out of the beginning balances matches the ending balance from the prior report, that the receipts and disbursements don't seem completely out of whack with what they have been in the past. So do some initial review of those and make sure you keep documentation of what you've loaded into the AFR, because you're doing this manually. So we talked about that. And again, if you have any questions, don't hesitate to ask. If it is anything about how the report should look, what you're filling in, what you need to have, content within the AFR, contact Rick or I. If it is gateway, technology assistance you need, contact the help desk, like a screen won't open or something won't save. That goes to the help desk. But if you want to know anything about what you're actually entering in the numbers, you can come to us with that. And that is the end, and it is time for lunch. We made it through the morning.
Yay! So yeah, they're in person. You guys can go to your lunch. I think Vicki might be getting ready to release you. If you are virtual, we are going to leave this open. So you can either log out and come back in, or you can stay connected. It's really up to you. But you'll be using the same link to get in for this afternoon, okay? If everybody could be back by 1, we do have Mike Nielsen that's coming in to talk to us about capitalization policies. Thank you. Enjoy your lunch.